How are commodity options prices calculated using math? Imagine trying to predict the future price of a commodity like oil or gold. How do traders decide what a fair price for an option on that commodity should be? Well, it all comes down to math. When investors buy options contracts, they want to know how much they should pay today for the right to buy or sell the commodity later. To figure this out, they use specific mathematical models that consider several key factors. First, the current price of the underlying commodity, often represented by the futures price, plays a big role. The futures price is the agreed-upon price for delivery at a future date. Then, there's the strike price, which is the price at which the option holder can buy or sell the commodity. The time until the option expires is also crucial because the longer the time, the more chances there are for the price to move favorably. Volatility is another major factor. It measures how much the commodity's price tends to fluctuate over time. Higher volatility means bigger price swings, which increases the potential value of the option. The risk-free interest rate, which is the return on a safe investment like government bonds, is used to discount future payoffs back to today's value. The core of the calculation uses models based on the Black-Scholes framework, adapted for futures options. These models estimate the fair value by calculating the expected payoff, considering the probability that the option will be profitable at expiration. They do this by creating two variables called D1 and D2. These variables measure how for the current futures price is from the strike price, adjusted for volatility and time. To find the option price for a call, the formula looks like this. The current futures price multiplied by the cumulative normal distribution of D1 minus the strike price multiplied by the cumulative normal distribution of D2, all discounted back at the risk-free rate. For a put option, the formula flips, using the negative values of D1 and D2. These calculations also involve what are called Greeks, which help traders understand how sensitive the option price is to changes in market conditions. Delta shows how much the option price will change if the futures price moves. Gamma measures how delta changes as the futures price shifts. Theta indicates how the option's value decreases as time passes, and Vega shows how the price reacts to changes in volatility. Understanding these math-based models helps investors decide whether options are fairly priced, whether to buy or sell, and how to manage their risks. The premium paid for an option reflects both its intrinsic value, which is the immediate profit if exercised now, and its time value, which accounts for the chance that the market could move in their favor before expiration. In real-world trading, factors like the difference between the local cash price and the futures price, called the basis, can influence the actual value of options. Market conditions, supply and demand, and liquidity can cause prices to deviate from the theoretical calculations. So, in essence, the prices of commodity options are calculated using mathematical models that combine futures prices, strike prices, time, volatility, and interest rates. These models give a structured way to estimate what an option should be worth today, helping traders make smarter decisions in the world of commodities.